All right, let's get started here. We're doing enterprise budgets and farm income outlook. I'm Gary Schnitkey, and Nick Paulson is in the room, and we're going to divide this webinar up. And our topics are corn and soybean prices, cost and returns, fertilizer, farm incomes, and then finally questions. As we're going through this, again, if you have any questions as we're going through this, put them in the box. And again, we're going to start with corn and soybean prices. So here we go. These are cash prices that are shown for corn and soybeans. It goes back from 2002 through 2022. It's updated through last week. So last week, and again, these are cash prices. We were looking at $6.68 for corn and $15.04 for soybeans. Again, those are cash prices, and we're still looking at those being relatively high compared to history, and in particular, high relative to the 2014 through 2020 period. We can see distinct periods of corn prices and soybean prices. They were relatively high during the ethanol build. We hit our highest in 2012 and then sort of began to decline after 2012. And that ethanol build was a part of that emphasis. We saw the trade conflict hit us in 2018, 2019. We saw a decrease in soybean prices. Soybean prices got particularly hit hard because of China's and exports of soybean. We had COVID hit us in 2020, and we saw corn prices come down considerably as it saw the COVID. And that was the impact of many different things, but primarily related to ethanol and reductions in fuel demand. Since then, we've sort of been on an upward rise. Actually began in 2020. And then we had the Ukraine-Russia conflict hit us, and we've actually been on relatively high prices since 2020, and the Ukraine-Russia crisis actually probably helped us some. We are now sitting at $6.68 for corn, again, $15.04 for soybeans. Again, those are good prices. If you're looking at this from a historical standpoint, we have here market year average prices for corn, soybeans, and wheat, 2022 and 2023, the projections, and this was updated this month. These are WSDA projections, $6.70 for corn. That's the highest we've had in recent years. And again, we started this all out at $3.36 in 2017 and 2018. We're going with a $5.80 projection for 23 and 24. That's our projection, and that's based on where commodity futures prices are now, as well as fall delivery prices. $14.20 for soybeans, going to $13.20 next year. Again, that's a fall commodity price forecast or delivery price, $9.10 and $8.50. All those prices are projected to come down for 2023, 24. Our budgets reflect those price declines. Those prices, by the way, are still relatively high, at least compared to history, but coming down. And again, as Nick will give us a little background here in a bit, those prices coming down will have impacts on our income projections for the coming year. One of the key questions, and we'll come back to that, is we sort of believe in agriculture in a long-run price, and from 2006 through 2020, corn prices averaged $4.22. We're above that right now, and you can see our USDA forecast for that as well as their CBO forecast. Point this out, Congressional Budget Office came out with their forecast last May. USDA, those long-run forecasts are from this November. USDA is now saying that we're going to come back sort of to this 420 mark, which would be interesting to have happen to us right now, particularly given all the cost increases that we've seen. Again, what we're seeing sort of right now is a move we're projecting a move down in prices for next year. That's based on futures prices, etc. Obviously, there's a lot of uncertainty about that, and poorer crops in Brazil and here would serve to increase those, and above trend yields may result in those being a little bit lower. But where we're going to in the long run is obviously a question that always comes up and we're always wondering about and drives a lot of our economics as we're moving forward. But we're not probably going to hit those long run prices, at least for 2023, right, Nick?
Yeah, I mean, both USDA and CBO are kind of building in a glide path over the next 2-3 years to get back to those long run prices. And, I don't think if you looked historically, those long run forecasts are ever correct. But it does say that, the long run modeling doesn't suggest that we've necessarily had any systematic changes in the global ag industry that would suggest we're going to average prices above kind of what we've been experiencing in the last 15 years anyway. So, things like Ukraine, Russia, weather in individual years are going to cause variations from that. But, I think planning for that long run pricing is something that needs to be considered. All right, so now we'll put that price information together with a few comments on crop yields, and then where we've seen production costs in recent years and where we're looking at for the 2023 crop year, and then combine that all together to look at returns. So first, I want to talk a little bit about crop yields, just to make the point that we've sort of been on a decades-long run, at least in Illinois, where we've had pretty consistent good yield performance, meaning we've had actual yield levels above what we would expect under kind of normal growing conditions, with the continual yield improvement over time, which we refer to as trend yield. So with the exception of 2019, the very wet spring, the prevent plant year, we've again basically had a decade where we've been above trend. So given the prices that have existed over those time periods, yields have been a very positive factor in terms of leading to more revenue than might have otherwise been the case with lower yields at the same prices. And in particular, 2021 and 2022, being not only above trend yields, but very high price levels as well, were definitely big factors in the high incomes and the high returns we've had the last 2 years. The same story it's the same story for soybeans. So again, we've had a decades long run, a little bit of a blip down in 2019, but a decades long run of above trend yields. And again, particularly the last 2 years, when we've got a few extra bushels above trend, that is definitely helped on the return and income side of things at the high price levels that we've had in the last 2 crop years. So moving on to the production cost side of things, we'll show you the chart here for Central Illinois. I believe in the handouts, we've got a chart for Northern Illinois, Southern Illinois. Obviously, if you're a listener outside of Illinois, these numbers themselves may not be accurately capturing averages for production costs in your area. But I think the trends are maybe the thing to focus on in those cases. And so we've got, in general, production costs never seem to trend downward persistently over time. We always see those things come up. They just tend to come up maybe slower during periods of lower prices. We saw production costs rise pretty rapidly when we saw prices increase during that ethanol build and soybean market expansion period from about 2007 through 2014. Slight decline and a kind of a plateau in production costs during the lower prices from 14 to 19. And then we've seen pretty dramatic increases in production costs the last 2 years, and what we're projecting ahead for 2023 there. So at least in Central Illinois, a total cost for producing corn of nearly $1,200 per acre, almost $860 in non-land costs, and then an average cash rent in Central Illinois probably surpassing $340 for the 2023 crop year. So we'll talk a little bit more about this later, but we typically see production costs adjust pretty quickly to higher prices, and unfortunately not as quickly to lower prices. So another factor to consider as we move forward. So we'll take a look at a little bit more detail behind the numbers in that chart on the last slide. So we've got our Central Illinois budgets that Gary put together and released in December of 2022. And so first we'll talk about the revenue side of things. Some of you might notice that we've got a $5.50 number here for corn and a $13 number for soybeans. Where we're at now, we could redo budgets every day. Again, these were put together in December. So $5.50 was what we were looking at in December on corn. Today we're saying probably closer to $5.80. So if you throw another 30 cents in there, maybe increase that revenue number by $60, $70 an acre for corn. Soybeans, I think we're at $13.20 was the price we were looking at if we were doing these budgets today. So, again, increase that revenue number on the soybean side by another maybe $40 per acre to reflect that price increase. But, a month from now, we could be below $5.50 and $13, depending on where the market goes. Here, I think we want to talk a little bit more about things on the cost side. So revenue side, again, the specific numbers maybe aren't the emphasis, but the fact that we are probably returning to revenue levels at maybe even slightly below what we experienced in 2021. And then so the real story here on this slide is what's going on the cost side of things. So direct costs, pretty dramatic increases in these. These would include your crop inputs and your chemicals. And probably the big driver that most of us think about here would be on the fertilizer side of things. We'll have a little bit more detail on that as we keep going. But over the last 2 years, a pretty big increase in direct costs for corn production. So, $160, $170 increase per acre there from 21 to what we're looking at for 2023. And a large increase even on the soybean side of things, which aren't as fertilizer dependent, but all input costs are going up. So, a $90 per acre increase over the last 2 years on direct costs. Increase in power costs as well. That's a combination of fuel prices. And I think it's also important to note that these numbers are based on the Farm Business Farm Management Association data. And so the power costs also do include a economic depreciation component in that power category. And so part of this increase is also reflecting the fact that the high incomes we've had the last 2 years have caused farmers to reinvest in their machinery complements. And so probably a bigger depreciation number there reflected in that increase as well. Overhead costs, increases, I think, across the board, but probably the one we're all thinking about right now is higher interest charges, as well as I think some pretty sizable labor cost increases in that overhead category as well. And so overall, if we look at the non-land side of things, over a $200 acre increase in per acre production cost for corn, about $150 increase or almost $150 per acre increase for soybeans. And again, comparing that back to, if we're looking at that 2-year increase on the production cost side, and we're back to where we were on revenues, that cost increase is basically going to come out of the net return we're looking at on a per acre basis. Land costs continue to creep up as well. So the land costs we've got reported here are average cash rents for the region. So about a 10% increase from $311 to $341 over the last 2 years for corn, or for land in Central Illinois. And so the punchline is that, compared to the returns we've seen the last 2 years, which again are historically very high and very good, probably returning down to some of the still positive returns, but lower return levels that we experienced in some of those years from that 2014 to 2019 timeframe. So this just gives you a visual, kind of give you in a historical comparison of what we call operator and land returns. So that's revenue minus those non-land costs, and then kind of contrasting that with average cash rent levels. Again, when we see those operator and land returns increase and at high levels, we see those cash rents adjust pretty quickly on the upside. When those land returns fall, we do see, usually some adjustment downward, or at least a plateauing in cash rents. But in the last 2 years, increases again in rent levels that are reflecting the high return levels we had in 21 and 23. And so if we look at that 2023 projection, the gap between that operator and land return, that cash rent still being positive, but much lower than what we saw in 21 and 22. Another thing we look at this time of year, some acreage decisions are still being made. Historically, we've compared corn returns, net returns to corn production versus net returns to soybean production. So what you see here is the difference. The bars in red are years where corn had a return advantage over soybeans. The years in green is where soybeans had a higher net return. And so during that low price period from 14 to 19, soybeans kind of consistently outperformed on the return side. Last 3 years, we went back to, I think, what's historically been more the case, where corn returns had the advantage. But looking ahead now, I think a lot of this is driven by the fertilizer side of things. Lower prices for both corn and soybeans, but fertilizer kind of having the bigger hit on the production cost side for corn. Maybe what I would call a slight advantage at this point. I don't think anything that's going to drastically change acreage decisions from what would kind of be part of the rotational consideration normally, but maybe a slight advantage predicted for soybeans in 23. And with that, I'll turn it back over to Gary to talk a little bit more about fertilizer.
Yeah, fertilizer has been getting a lot of attention in the last several years, and let's go through this. Fertilizer prices have increased very dramatically, and we hit highs in the past several years. Right now, we are looking at anhydrous ammonia prices at $13.08. This comes from the Illinois Production Cost Report, and that would be from those prices are up to date and are from the first part of January. As you can see there, we're at $13.08, and that has been a decline a bit from over $1,400 levels earlier in December and November. So we've seen some backing off of that fertilizer price, but still at very high levels. DAP has come down in recent months, $8.32, as well as potash, which has come down and is now at $714 per ton. Unfortunately, for most farmers, you put most of your DAP and potash on in the fall. So those, if you've made those dry fertilizer applications already, you can't take advantage of those price declines. Obviously, if we're putting it on in the spring, we still have some opportunities to take a little bit of advantage of those price declines. But having said that, we've declined from both of those at very high levels, and those prices still represent very high levels. Just a brief history of where we've been at with anhydrous ammonia prices. And again, this is the one, anhydrous ammonia and nitrogen solutions perhaps are the most volatile. I don't know. And also perhaps the ones that could come down somewhat in going into the spring. A brief history back in August and September of 2021, which seems like a long time ago, anhydrous ammonia was at $750 per ton. And at that point in time, we began to see the planned shutdown extended because of Hurricane Ida. There were planned shutdowns of anhydrous ammonia plants in the New Orleans and Delta region of the country. Those got extended because of Hurricane Ida, which was actually a pretty large storm. We also saw increases in corn and natural gas prices, and Europe had, because even at that point in time, had large increases in natural gas prices. All of that led to rising anhydrous ammonia prices, and we were up to $1,400 before the conflict between Ukraine and Russia began in February of last year. That Ukraine-Russia conflict, we saw anhydrous ammonia cost increase to $1,600 per ton. And then we saw a bit of a decline of those prices down into the below $1,200 range in August and September of 2022. Those prices then rose, and now we're sitting at January 2023 in that high $1,300 range. Anhydrous ammonia and all nitrogen fertilizer prices closely follow corn prices, and right now we're not expecting corn prices to really decline much going into the spring, and natural gas prices. And we may get a bit of relief from natural gas prices because of the relatively mild winter so far. Don't want to jinx our luck here. I've personally enjoyed the January that we've had, but relatively mild. We'll see what February and March occur. But even given that, I think we're still looking at anhydrous ammonia prices maybe declining some into spring, but still relatively high levels. Traditionally, January, February is a good time to buy. Does this hold true this year? This is a good question. So what impact do you see of higher fuel prices having for farmers? First, that we've seen fuel cost increase quite dramatically. So, and those cost increases have been significant, and significant enough that, we're looking now at fertilizer cost fuel cost at a relatively high level, and they begin to matter in our budget. Traditionally, January, February is a good time to buy. Does this hold true this year? Well, we'll see in March or April, or maybe later. Good question.
Yeah, it's sort of makes me think of a comment I made when we did these in person a few weeks ago. It was one on the fertilizer side. I don't think if I'd told anybody 4 years ago that they would think $1,000 anhydrous seemed cheap, that they'd believe me. But we're kind of in a situation like that now. I sort of think of fuel that way too. This summer we were lucky enough to drive my daughter out to summer camp in Maine, and of course that's when gasoline was $5. So when I see that it's $3.20 at the pump here in Champaign, I feel like it's pretty cheap. But a year ago, I wouldn't have said $3.20 gas was cheap either. So it's a good question. I'm doing the classic talking around answering it, but if we knew where fuel prices were going to go, I guess we'd be doing something else.
Yeah, and again, we have the demand situation as well as the Ukraine-Russia situation, which seems to be reaching an equilibrium of a continuing war, which we're getting used to having. And so unless something explodes there, we're probably at the levels that we're at. Just a reminder that our dependence on imported fuels, nitrogen, we import only 12% of our nitrogen. The rest is produced in the United States, and our major sources of those are Trinidad and Tobago, Canada, Venezuela, and the two big ones are friendly countries to us. So, but you have to remember that Brazil's also going to be needing more nitrogen fertilizer, and they're going to look at those two sources as well. Phosphate imported 9%, and potash 93%, and most of that comes from Canada, but Russia and Belarus are still major sources of that. So we have some vulnerabilities there. Again, I would say more or less that we've reached sort of an equilibrium where we expect the Ukraine-Russia war to continue, and we're working around that. But still, that conflict hasn't made anything cheaper.
Yeah, I think the volatility premium that was probably existed in the market when the Ukraine-Russia conflict was new is probably sort of sorted itself out. So we're at elevated price levels, but I would expect maybe lower volatility going forward. these are all global markets for these fertilizer products. But again, I think one advantage the U.S. has is being not as reliant on some of those regions that Brazil, for example, being much more reliant on getting these products from that Black Sea region. And so while we're all going to face higher prices, I think, some of the actual supply concerns and issues are probably less of a concern for the U.S. And but a lot of those that existed, a year ago, I think didn't even play out like we thought they could. I think most farmers were able to get access to product that was just at higher price levels.
Yeah, and you would expect people to get access this year, but planning ahead seems more important in the environment now. We stretched supply chains quite a lot in the past several years, and planning and making intentions known with suppliers is important, and it's probably going to become less and less of a time where you can make acreage decisions and switches later in the spring because of all those supply chain issues.
And Gary's outlined, strategies to consider on the fertilizer front. Spreading out purchases across the year to sort of protect yourself from buying everything at the high, or smoothing out some of those supply concerns if they exist. And then, I think, even considering, reducing application rates is something to consider when fertilizer prices are at the levels they're at. And we have a lot of research in Illinois that suggests farmers could reduce rates, reduce use, and probably not see a big yield penalty, at least in the short term.
Yeah, nitrogen, those studies exist, and even in P and K, we see soil test levels well above those of maintenance. And now's not the time to maintain high soil test levels with high fertilizer prices. With that, farm income.
Yeah, so I guess I get the pessimistic parts of this presentation, although I guess fertilizer is not a great story either. So, one thing I do want to say before we talk too much about the drop in farm income we're projecting for 2023 is, to just remind ourselves, we are comparing this to two very, very good years in 21 and 22. And so again, this is based on data from the Farm Management Association here in Illinois. This is actual commercial farms throughout the state. Really value the partnership with them and what it does for us on the research side of things, and be able to communicate this stuff out to our audiences. But record-breaking farm income in 2021. What would have been record-breaking income again in 2022 had it not been for what it was the year before. And then, given the price decline to still high but lower than the last 2-year levels, and the kind of the production costs catching up to us, are projecting farm incomes considerably lower for 2023, not negative, but back kind of in that range that we experienced again during that lower commodity price period from 2014 to 2019. So, I think a lot of parallels potentially between where we're at right now, where we're looking at where we might be in 2023 and moving forward. Very similar potentially to what, how we came out of 2012 into a period of lower prices. And sort of related to that, one thing we did want to include here is to sort of give a little bit of an indication of where we see farm operations at from just an overall financial perspective. So again, sort of comparing where we're at now on the liquidity side of things relative to where we were at in 2012. So if we are looking at, an extended period here with lower prices and higher costs and lower returns, we're sort of back to that financial position that we were in 2012. And, by and large, I think most farms were able to sort of navigate that lower price, lower return environment from 2014 to 2019. And so I think, the point here that we want to make is, we're in a position to do that again if that turns out to be the case. Not saying that that's necessarily what we are expecting or should be expecting. We're looking at lower prices and higher costs in 23. Don't know what 24 or 25 will bring. But if we do find ourselves in a lower return environment for multiple years, you know, I think we're well positioned to kind of go through that. Same thing on the leverage side of things. So if we look at the debt to asset ratio, we've got this across different age categories. Obviously, younger farmers are going to be using more leverage typically than what we see among our older farm operators. But in pretty much every age category here, you know, we had increasing leverage, you know, more use of debt relative to assets from 14 to 19. And then as we saw high returns, higher incomes the last few years, we've seen farmers pay that debt down on average and kind of get back to a leverage position that we were in back in 2012, 2013. All right, so now we're going to kind of talk about we have some questions, I guess, and kind of some answers, but bigger picture questions for the future. So, you know, one thing that everybody's always interested in is what are long run prices, or what should we be planning for in terms of long run prices. And before we maybe provide our thoughts on that, we want to open it up to our audience and see what they think about what corn prices will be, say 5 years from now. So give you a few seconds here or so to respond, but what do you think corn prices will be?
Yeah, and just remember that we made projections of income here. We're having that come down $81-ish thousand. That was based on a $5.50 corn price and a 13-ish soybean price. So those are significantly above where we've been at. And again, if you look at where markets are today, that would be roughly what you're suggesting they would be. You know, if we have a lower, you can be optimistic about prices if we don't meet those supply issues, and if we have above trend yields, you know, we'll probably have lower incomes, or excuse me, lower prices as well. So let's see what you all think. So here's the results, and you can write this down and keep it in posterity. So 36%, we have this
a very normal looking distribution.
Very normal distribution.
So the average from responses here would be right in that $5 range. So maybe a little more optimistic than what our friends at USDA and CBO are thinking, but yeah, that looks like a pretty clear average around that $5 mark.
So here's just a recap of where we've been, and then we'll give you so 450 and 5 was sort of where that was centering at. Just a reminder of what we think, or maybe what most economists think, is that there's long run periods in which prices don't trend up or down, but vary around a long run average. From 1974 through roughly 2006, that was $2.38 for corn, $5.98 for soybeans. Then we had the ethanol build, and since then we've been average $4.38 for corn and $10.60 for soybeans. If you look at what USDA is saying, in the long run, they're bringing prices back down to that $4.38 and essentially $10.63. So they're saying, these long run models are saying that we have not seen that break that has caused that break. And the last time we had that break, it was caused by the ethanol build and continued strong demand for soybeans in export, with that going primarily to China. And before that, it was the increase, that 74 increases was likely due to increase in exports. So what do we think moving forward? Well, we're sort of close. We agree with everybody out here. High, maybe not as optimistic as 5, but high $4 for corn, $12.50 for soybeans. So I guess a bit more optimistic than USDA, and that probably, Nick, my optimism on that would be because, or not, maybe not optimism, but you know, costs have gone up so much, and we can see this continuing inflation environment, but that is what it needs to be, and that's where it will be.
Yeah, I mean, call it optimistic if you want. I think one, the cost environment that we're in, I think we'll continue to be in, just probably won't support prices too much lower than that. So, I think that's probably one of the reasons I'm probably more in this range as well. But another question we get is, well, if we are heading into definitely 2023 lower prices, or not definitely, but we think 2023 lower prices, what happens if that does last multiple years? What happens when prices do come down?
So we had a question here: should we adjust long run crop prices averages for inflation? And that's something that that this responder always thinks about. Here's my answer to that. And history would say that you should not, because if you look at those long run prices, that we had a relatively stable period from 74 on to 2006, and we had really high inflation in the 1980s. So the last time we had inflation, we did not see an increase in long run prices. And so history would say no. And actually, you could support that also with what happens in other commodities like oil, etc. The thing that's different, I think, now is we had that large cost increase. So
yeah, in real terms, commodity prices have tended to decline through time, meaning there hasn't been that sort of inflation adjustment on the commodity price side. So next question: what happens when prices do come down? So again, we'll put it to the audience first with the poll. So what do you think will be the response on the cost side if prices do remain at lower levels than we've had the last 2 years, maybe even revert back to kind of that longer run average of that higher $4 range for corn, somewhere in the $12 range for soybeans?
So yeah, so we're building a scenario a bit of eventually, maybe not this year. And again, I think you could build a case if we have low yields that we continue to see higher prices, even above what we're using in projections. And maybe some other factors will play into that, but eventually prices, this is agriculture, eventually prices come down. So what happens to costs then? So we've all voted, or we have had 61% of you vote. And now we're going to show you the results. Decrease substantially, 2%.
All right.
61% say decrease, 33% say the same, and then we have increase at 5%. So
again, I think our average of our audience responses is probably pretty consistent with what we think, as well as I think what we have experienced historically. So on that historical experience, again, I'll kind of point to what happened during the ethanol build and then following the ethanol build. So we saw dramatic increase in prices, high returns for a number of years from that 2007 to 2012 period, some great farm incomes. And then we got into a period of lower prices that lasted basically up until 2019, 2020. And if you look at our non-land cost and total cost, when you include the cash rent bars here, you can see that yes, costs did adjust to those lower prices, but the key point here is when and how quickly does that adjustment made. And so we typically see lags in production cost adjustments in both directions. Unfortunately, the lag on the upside tends to be maybe a 1 year adjustment period, but on the downside, it can be sticky and maybe takes a couple years for costs to come back down and reach levels that are at least sustainable relative to where those price levels are at.
So all of those that have told us over the years that yes, costs go up faster than when prices go up than when they come down, you're right, they do. So you're in, and again, this slide shows that. So and one other thing that I would say is that as we looked at those price declines, we saw a number of years where we were looking at farmer returns being negative, and that seems to be what you do need to see happen when you're looking at price cost declines, both from a rental standpoint and from other cost standpoint. History would say that for significant declines to happen, you have to see price declines as well as some negative farm returns. Looking at the individual cost, we see the most variability in that fertilizer cost area. And if you go back and forth through time, fertilizer costs can tend to come down. So if you're looking for relief in any area, it's likely to be in the fertilizer cost. And here we're just showing selected items for Central Illinois. We have the power cost, and once they've reached new higher levels, it's hard to get those to come down. Perhaps we'll see some moderation in that because of lower fuel prices. But the big items that influence that are depreciation and repairs, as well as machine hire. But depreciation, repairs, I don't think anybody is expecting repair costs to go down, particularly with labor shortages, and a particular labor shortage in skilled labor that do things like repair machinery. And depreciation's not likely to come down because all machinery prices have gone up rather significantly, so you don't expect that. Seed costs have risen, and again, you don't typically see that coming down. Pesticide costs, again, don't typically come down. And if you see some inter-year variability in pesticide cost, it's usually due to increased use because of some sort of pest problem. We've seen that increase dramatically in the recent year pesticide costs from 2020 through 2023. Part of that is resistant weeds. Part of that is just high cost associated with the basic ingredients of pesticides. Again, history would suggest that those won't come down.
Yeah, and I think another thing driving the higher pesticide costs, or the maybe the higher than usual increase the last few years, is the high price levels and the returns that are out there that you want to protect. And it's a lot easier to pull the trigger on those pesticide applications, whether that's fungicide or some other problem, when you've got more dollars out in the field that you want to make sure they're in the fall.
Yeah. So what happens when prices do come down? And we would agree with what you said. Production costs lag before they come down, and we would not expect our production costs to come back down to levels that are
reflecting the size of the price decline.
There you go. That's a nice way of saying it.
All right. The other hot topic beyond fertilizers, I think, has been interest rates. And so what will happen to interest rates? So again, we'll put the question to our audience first. So what do you think interest rates on ag loans will be at the end of 2023? I know there's a lot of different kinds of ag loans. So are we asking about long-term farmland borrowing? Are we asking about operating loans? We weren't that specific, but
this isn't a scientific poll.
What's the neighborhood of interest rates you think we'll be in at the end of 2023?
Yeah, and to give you a feel that right now, long-term real estate loans are in the 80% range, and operating notes are a little bit less than that, I guess. There we go. So what do you think? So
we have a few more seconds to respond here. We'll get Jim to put the results up for us. I think we're good. All right. So it looks like our audience is kind of expecting to probably be in the same neighborhood we're in right now, or maybe potentially even a bit lower, which I think is consistent with messaging from the Fed recently, given the relatively good news we've gotten on inflation in the last few reports. Gary, you want to talk about the inflation interest rate gap here?
Yeah, so we've seen, obviously, and this shows the inflation rate, the 10-year CMT rate, and the federal fund rates from 19 1955. That's older than I am. Just so we all know, 1955. That's older than I am. Up to the present, and obviously the thing that sticks out is the 1980s and the war on inflation that was waged then. And then in recent times, we've seen that inflation rate rise to levels that were not seen since the 1980s, and we've seen some backing off of that. So then the question is, where are we at as far as inflation rates, and do we expect those to come down further? And I'm going to just make a couple points here. You typically don't see long run periods where the inflation rate is above the 10-year rate. You see those occasionally, and you're seeing that now. That would say that our participants in the 10-year CMT rate believe that we're going to have lower inflation, and that lower inflation is going to come down, continue to come down. So the long run question then is, where do you expect long run inflation rates to be? And people will differ on that. I personally do not expect those inflation rates to go back down to what they were here in the 2010 to 2015 or so period. I would expect those to be a little bit higher. And the reason why I would expect them to be higher is just simply the labor market. And there's going to be impacts on labor push cost increases. Anybody that needs labor is going to continue to have a problem with labor because we're not producing. We did not produce as many babies back a while ago, and we aren't allowing immigration, or I don't know how to say that exactly. We have immigration issues, and all of those things are going to keep the labor market tight. So,
yeah, we've sort of, I think a lot of people, look at COVID and maybe blame the stimulus that came out of that as far as negatively impacting the workforce. There's evidence that we've lost workers. Labor force participation rates have kind of rebounded to where they were pre-pandemic, but there's just fewer people out there in the labor force. And, the longer term, medium term projections are not that that's going to drastically increase. And so immigration is one potential solution to that, but the labor force is not growing as rapidly as we have seen. And so, yeah, I think all that leads to higher inflation than maybe what we've become accustomed to.
Bring on those autonomous tractors, I guess, we have higher, I guess, so we'll have higher than we saw from 2018 to 2021, leading to higher cost of capital, higher break-evens for investments, and downward pressure on cash rents. Again, we're sort of in the ballpark of where our participants were, 8 coming down to 6, but don't expect, I guess I would not expect this to get back to those levels that we were previous to this. So farm incomes have been above average, and 2023 could we'll use the could yet continue to be a profitable year, likely less so than in 2021 and 2022. And even given if we had 650 corn continue into 2023, we would have lower profitability just simply because of cost increases. And when prices decline, there will be adjustments. May not be in the year that those price declines happen. So, Nick, anything to add there?
I don't think so. I think with that, we'll open it up for questions. Looks like we got a few we could try to tackle now. Before we get there, though, we'll give you a few minutes to type in others. Always want to recognize the sponsors of the Farm Doc project. So got those on the screen in front of you there. The TIA Center for Farmland Research, Compure Financial, Cortiva Agriscience, Farm Credit Illinois, Illinois Corn Growers, Growmark, and the Illinois Soybean Association. We heavily rely on and appreciate the support from those sponsors, and they make it possible for us to
keep
keep
doing
doing
that.
the things that we do and
We
provide
appreciate
this
that.
information to you all.
We also want to thank a University of Illinois Extension, FBFM. FBFM is the source of much of our data for incomes, etc. And the University of Illinois Department of Ag and Consumer Economics Department, because we're from there. So there you go. Just a note, we will have, there's going to be a Thursday webinar for the next while. We have 4 scheduled. Next one is South America, and Joanna Calusi will tell us about what's happening there. And she was a star of our show.
She was the hit of the in-person events that second week of January. Joanna's from Brazil. Got a lot of great insights and information to share on South America and the role they're playing in agriculture moving forward. And with that, we will tackle some of the questions. So first one we got is thoughts on increased supply of nitrogen fertilizers from global suppliers, including maybe production expansion even here in the U.S. Do we have any inside industry info? I don't think we have any inside industry info, but I don't know, Gary, you want to comment on?
The one thing that I would say is that that the European situation has calmed some, and some of the shutdowns that we've seen in Europe may no longer be in place, and that will help our national worldwide supply situation, which could have impacts on our prices. Again, I would not be expecting low nitrogen prices this year, and if we get down to $1,200 for anhydrous ammonia and roughly the equivalent of that for nitrogen solutions, that would be a win for the year. But that would still be above what most people have paid last year, even in the years before.
Why are the USDA and Congressional Budget Office long-term price trends different? Do we have they are independent groups. They compile and put together those estimates independent of one another. Gary, do you have any other insights as to why?
So the Congressional Budget Offices came out in June. And USDA came out in November. And USDA, if you look at what USDA did, they increased their long run price projections from last year, February, to this year. So I would just say it's the time of the year, and their long run models, which are people based, have revised their things up. And I would expect Congressional Budget Office, which should be coming out soon with their revised projections here in February, March.
Yeah, and I would also, this isn't really to the question directly, and I also point out that the purposes and uses of those things are different as well. So CBO projections will actually be a big factor in baselining for farm bill discussions, farm bill negotiations. USDA outlooks have other purposes, but yeah, I think the difference in timing is a big component of that. If you compare those historically, there are always going to be some differences there, and they come out at different times of the year. And as we said, even with the budgets Gary works on, what you think in December can even be a lot different than what you think in January or February.
So what are your projections for ethanol production and corn usage?
I don't think that that should be viewed as an area for potential major growth in corn use. I think where the policy currently stands, if we're talking about the RFS, there's going to have to be some creative approaches to ways to, if we want to think about increasing corn use for ethanol or biofuels in general, I think they're going to probably be outside sort of the standard fuel markets, whether that's going to be pushing for higher blend rates, pushing for fuels that can be used in not the traditional transportation sector. But there's I think some pretty big headwinds in the growth for ethanol use. One is just sort of the leveling off and potential decline in gasoline use in general. And then as policy currently stands, we sort of still have the blend wall to think about too, where we can't really physically get past more than 10% of gasoline use, a bit past it with some E85, some E15. But unless there's some changes to current policy, some creative tweaks, I view that as sort of probably a consistent use of corn for ethanol in bushels, but as yields continue to increase, probably a smaller and smaller share over time of total corn use going to ethanol.
Yeah, we want to put a plug in for friends at National Ag Statistical Service. A very important source of information that we use quite a lot, and they are doing the Ag Census. No.
The response period is open. If you're in Illinois or a farmer in any state, you should have got a questionnaire in the mail, or likely did get a questionnaire in the mail. You can respond online. I think it's agcounts.usda.gov. I launched my spokesperson career this morning on YouTube we put together, Jim made me look better than I actually look, but we've got a video out with information, links where you can access ways to respond to that. But just want to help our friends at NASS make sure they get the most responses possible. That is very important information for the industry as a whole. Important for us as researchers, but I think more importantly, just important for farmers so that they're accurately counted and we have good information on the industry so we can design policy that's helpful and beneficial to agriculture moving forward.
And with that, we thank you for being here today. Stay warm. I think it's supposed to get warmer, and maybe, I don't know, watch the Illinois play basketball here, and we welcome you back next week.
Yeah. Thanks, everybody.